Our next speaker, Mr. Ronit Ghose, Global Head, Banking, Fintech, and Digital Assets at Citi Global Insights, speaking on today's topic, Future of Money, CBDCs, Crypto, and 21st Century Cash. Over to you, Ronit.
Great. Thank you for having me. Over the next 15 minutes or so, I will try to explain why the nature of money is changing. In the next few years, 5-10 years, electronic money will shift from the paradigm it's been in for the last couple of decades, what we call digital money 1.0, to a new paradigm, digital money 2.0. Digital money 2.0 will be different to digital money 1.0 in terms of the technology and the implications of this technology. On this page, I try to explain at a very high level some of the differences between DM 2.0 and DM 1.0 or e-money. A key difference, as I said before, is tokenization. E-money or digital money 1.0 is account-based. Digital money 2.0 is tokenized. It's the equivalent, the digital equivalent of having the dollar banknote in your wallet or the sterling banknote in your wallet. I could transfer it person to person to you from me electronically. Now, in DM 1.0 or e-money, that's not possible. What happens in EM 1.0 or DM 1.0 is you're simply moving numbers in a digital ledger from one ledger to another ledger. You are not transferring value atomically or directly. Now, the technology of digital money 2.0 is usually blockchain-based. It doesn't have to be, but it's usually blockchain-based. And some good examples of this would be Bitcoin, that's been around for a decade or so, the so-called DM proposal from Facebook, or CBDCs, central bank digital currencies. This is the central bank's effort in the space, and we've already seen many central banks around the world pilot digital money projects. And what we're going to see in the next couple of years is that we're going to have a lot of projects beyond pilot. You're going to go beyond white papers and green papers or whatever, and you're going to actually start seeing people in real life using CBDCs. The best example of this is going to be China at scale. We think other countries, particularly in emerging markets, in Europe, and maybe even in the US will follow. Now, we don't believe that the growth of digital money 2.0, so central bank digital money or cryptocurrencies, which we think will grow tremendously in the next decade, we don't think it's going to lead to the decline of e-money. We think what's going to happen is that all digital form factors are going to grow together. It's simply that the digital money 2.0 you see on the right-hand side of your screen under the red, we think that's going to grow faster at a much faster rate than the digital money 1.0. What's going to happen is that other form factors, so cash, checks, etc., will continue the trend they've been on, which has been a trend of decline. Now, that's an obvious implication of this big mega shift. There are other implications that are quite significant, and they impact the banking system, investing, civil liberties, freedom. And let's dig into some of these other implications as well. So for the banking system, the growth of digital money 2.0 is actually quite dangerous, potentially, if it's not regulated and not controlled. One very specific risk factor for the banking system is what happens to the funding base, what happens to deposits. There could be an increase in both the cost and the volatility of deposit funding for commercial banks as digital money 2.0 grows. Now, there could also be new revenue and business opportunities from crypto growing. However, the immediate or initial impact, and this is something that the banks and the policymakers will need to work out together, is that you could start seeing money move from existing electronic money into these new forms of digital money. And these new forms of digital money will be typically stored in wallets that may or may not be provided by banks, such as whether it's a big bank in the region or internationally. It could well be provided by big tech platforms. It could be provided by, just like during the pandemic, many of us began using our phones even more, particularly for contactless. I know that I, for example, use my Apple Pay constantly. That's become my main wallet now, not my physical wallet. And that's really happened and it's accelerated around the world during the pandemic. Happens to be I use Apple Pay, others use other form factors, whether it's Samsung or Google Pay. And big tech platforms have been very good at seizing and capitalizing on these new opportunities faster than some of the incumbent banks. So we believe that one of the implications of the growth of digital money 2.0 is going to be a further concentration of financial services into big tech platforms. I've talked about the change in the payments landscape already, the continuing demise of checks and cash. There could also be at an international level an implication in terms of policy. As other countries outside the US pursue digital money 2.0 faster and further, maybe, there is going to be the potential for the internationalization of national central bank digital currencies. And this could be a risk. We think it's a theoretical risk, but this could be a risk to the US dollar. So as the growth of the RMB or the ERMB or the EUan or the growth of Bitcoin, you could see money move out of the US dollar or more likely local currencies, particularly in emerging markets, into these new digital form factors. So for policymakers sitting in parts of, say, Africa, Middle East, South Asia, this is going to be something to keep a very close eye on. As you see the further growth of, say, ERMB or Bitcoin, do you start losing some of your own domestic reserves? Do you get the equivalent of a de-dollarization of your economy? Do people stop using your own currency and start using other currencies? So there's quite a big kind of cross-border political and policy angle to digital money. A final point to bear in mind is the domestic policy positives from digital money 2.0. One major positive is greater targeting of fiscal and monetary policy. Now, fiscal and monetary policy today tends to be conducted through interest rates, bank reserves, bank regulation, and obviously direct spending by the government, the state. Now, with digital money 2.0, you can do your direct spending. We can target it much more carefully. So think about during the pandemic that we've just lived through, or we still in many parts of the world living through, when aid was dispersed, typically what happened was initially checks went out or there were direct bank transfers made. In the future, a central bank could simply zap you their CBDC to your digital wallet, and they could put restrictions on it. You have to spend it in the next, say, 3 to 6 months, or you have to spend it on certain types of services or goods, like you have to spend it on rent or food and shelter. And so there's a much greater policy flexibility and targeting that digital money 2.0 allows. And of course, the other side of the coin is, and this is a concern for civil liberties and from a political perspective, how much control do you want to hand over to the state? Now, that's a discussion from maybe a different forum, but I'll just leave it out there. Digital money is not just about money. Like with all things to do with money, it raises big questions about society as a whole. Now, diving into a couple of more numbers-driven slides, I want to talk a little bit about just the sheer growth of digital money 2.0 in the last couple of years. What you're seeing is significant increase both particularly in the non-centralized or decentralized world. The number of cryptocurrencies has exploded. Buyer beware, a lot of these can be scams or frauds. But the core, the more popular, well-known cryptocurrencies, Bitcoin, ETH, these are now significant in size, particularly in markets such as the US and some emerging markets. You're talking about an asset class that's about $2 trillion in value. So this is already very big in terms of just size we're talking about. And this is why we think policymakers, investors, bankers, they can no longer ignore this in a way we could a couple of years ago. It's simply too large now to ignore. There's also significant public interest in this topic. You can see on the top left-hand side, and this is sort of Google search index over time, the significant increase again in the last 12 months or so in Google searches for Bitcoin and digital currency. We're back to sort of 2017, early 2018 levels, previous peak levels, significant public interest in this topic. I've just come back from a summer break, and my 88-year-old father-in-law was asking me about CBDCs. This has literally become now a dinner table conversation topic. Now, in terms of the financial industry, and again, just try to put some numbers around it, we're talking about trillion-dollar implications, because what digital money 2.0 challenges is not just banknotes and cash, so what economists call M0. So this is M0. So M0 is the banknotes you have in your wallet, the reserves a commercial bank has in a central bank. There's about $15 trillion of M0 globally. The Chinese authorities and policymakers have said that as part of their CBDC effort, they want to replace M0 in China with this new form of money, digital money 2.0. And they said, if this was true globally, you'd see $15 trillion shift into CBDCs and similar assets. Now, this could be a bigger subject than $15 trillion, because as I said earlier, what you could see move isn't just liquidity and cash. You could start seeing bank deposits move. And if you look at M1, and economists use this term M1, M1, as you probably know, is bank deposits as well as cash and central bank reserves. It's about 70 trillion of M1 in the world. We checked out the number of banks we cover in City Research around the world, and my colleagues in City Research, and we came to an estimate of north of $70 trillion of global bank sector deposits. It's roughly similar to the economists' calculations for M1 around the world. You're talking about $70 trillion of assets today that could be in some way or the other shifting in the coming years. In terms of why are policymakers keen? Why are they interested in pushing or exploring digital money? When it comes to retail CBDCs, financial inclusion and domestic payment efficiency are some of the key drivers. Let me explain this a bit more. What you've had in many countries, such as in China, at least the eastern seaboard of China, or you've seen in Scandinavia, is you've had digitization already happen. But what has happened is that you've had private sector companies drive that. Now, that's great from an innovation perspective, also from a social welfare perspective. Digitization normally leads to more efficient payment systems. However, there is a risk of basically money, or particularly retail transactions, being controlled by one or two institutions, private sector institutions. And not everyone has access to those one or two private sector institutions. So having a state alternative in the form of CBDCs does, theoretically at least, promote financial inclusion. It also improves payment efficiencies for similar reasons. I won't go into all the details of why you should do a retail CBDC, but those are two of the reasons that central banks typically give. Now, on decentralized crypto, sorry, just give me a second. I'll just move forward. On decentralized crypto, there are some negatives and challenges that we have to bear in mind. One is that today it's still highly concentrated. So most of decentralized crypto, so Bitcoin or ETH, is held by a small number of people or a small number of institutions, exchanges, high net worth individuals. Yes, there's at a base level in the US or in certain countries like Nigeria or even in South Asia, you're seeing increasing usage of cryptocurrencies, but there's still a very strong concentration of where this is held. In addition, the actual creation of what's called mining of Bitcoin is also very concentrated. And you see in the bottom right-hand chart, it's been heavily concentrated in China. That is slowly shifting this year. It's increasingly moving into neighboring countries in the ex-CIS and the CIS countries, ex-Soviet Union countries, also into North America and Scandinavia, wherever there's relatively cheap energy available. But there is a concentration concern, and there is also an energy ESG concern that we've got to be sort of wary of. Bitcoin does consume a lot of energy. I'll just leave the slide here in terms of the positives and negatives. All of this information is available in much more detail in a variety of reports we publish. This report here in the bottom right-hand corner is the one I've been talking about. You can Google it if you want to sort of dive into more information. It's called The Future of Money. So if you just stick in Future of Money into your search engine of choice, and you can put in my name or city, and the report will pop up, and then you can dive into and dig into in a lot more detail what I've been talking about over the last 10, 15 minutes. Thanks for listening. It's been a pleasure to present to you today.
Thank you, Ronit. So, attendees, if you all have any questions for Mr. Ronit, please kindly share it with me, and I will pass it on to him, and he will reply back to you. Thank you, Ronit, for your time and presentation, and my regards to your dad. Thank you, sir. Thank you very much.
Thank you.